Imagine a place where banks park trillions of dollars every single night. It's not a commercial bank, it's not the stock market, and it's not a government vault. Yet this hidden system quietly influences interest rates, liquidity, and sometimes even the stock market. It's called the Reverse Repo Facility, and if you've never heard of it, you're not alone. Before we explain how it works, here's why you should care. Every day, banks, money market funds, and large financial institutions manage enormous amounts of cash. Sometimes they have more cash than they know what to do with. Instead of letting that money sit idle, they can temporarily park it at the Federal Reserve. That decision affects how much money flows through the financial system. And when liquidity changes, stock prices, bond markets, and even mortgage rates can react. That's why professional investors watch the reverse repo facility closely. So, what exactly is it? The Reverse Repo Facility, often shortened to RRP, is a program operated by the Federal Reserve. Think of it as a giant overnight parking lot for cash. Eligible financial institutions lend cash to the Federal Reserve overnight. In return, the Fed provides Treasury securities as collateral and pays interest on that cash. The next business day, the transaction is reversed. The institutions get their cash back with interest. The Fed gets its securities back. This happens every business day and helps keep short-term interest rates under control. Let's make this simple. Imagine a money market fund finishes the day with $10 billion in cash. It doesn't want to leave that money sitting idle. It also wants a very safe place to keep it overnight. So it lends that cash to the Federal Reserve through the Reverse Repo Facility. In exchange, the Fed temporarily hands over U.S. Treasury securities as collateral. The next morning, the Fed returns the cash plus a small amount of interest, and the Treasury securities go back to the Fed. From the institution's perspective, it's like using the safest overnight savings account in the financial system. When many institutions choose the reverse repo facility instead of lending money elsewhere, cash is temporarily pulled out of broader financial markets. That's why investors often describe the RRP as a tool that can reduce liquidity. Here's a real example. During and after the COVID-19 pandemic, the Federal Reserve injected enormous amounts of money into the financial system through asset purchases and other emergency measures. As a result, many financial institutions ended up holding far more cash than they wanted. The reverse repo facility became a popular place to park that excess cash safely overnight. At one point, daily usage climbed above $2 trillion. That wasn't because the economy was collapsing. It was because there was simply an extraordinary amount of cash in the financial system looking for a safe, short-term home. Investors watch these numbers closely because they offer clues about overall market liquidity. Here's the biggest lesson. The reverse repo facility is not a warning sign by itself. It's simply one of the Federal Reserve's tools for helping keep short-term interest rates stable and managing liquidity in the financial system. Changes in RRP usage don't automatically mean the stock market will rise or fall, but they do provide valuable information about where cash is flowing and how financial conditions are evolving. So the next time you hear analysts mention the reverse repo facility, you'll know they're talking about one of the quiet systems operating behind the scenes of the U.S. financial markets. Subscribe for more videos where we explain finance in simple English.